If you're a North Carolina family sitting on a $2 million brokerage account with a $200,000 basis, you already know the tax hit that's waiting for you. A charitable remainder trust can be the tool that changes that math. Here's how it actually works and when it fits. So what is a charitable remainder trust? A charitable remainder trust, or a CRT, is a trust that you set up now and contribute appreciated securities to create a charitable deduction now, to avoid the capital gains implications of liquidating those securities now, and create a legacy bequest to that charity, an income stream for you for life or for a period of years that you determine ahead of time. The trustee of that trust receives the securities and sells them immediately without capital gains consequences to you. All that's required is that you get an income over time, and whatever's left in the trust goes to the charity after the income term has expired. And you'll get a partial income tax deduction for the amount of benefit that you've transferred to the charitable remainder trust today. If this sounds like the legacy that you'd like to leave behind, click the link below. Now, there's generally two flavors of charitable remainder trust. There's CRUTs and there's CRTs. A CRT is a charitable remainder annuity trust, and that means that the trust will pay back to you the same annual amount every single year, regardless of if the trust grows or reduces in value. A CRT is a charitable remainder unit trust, and that's a trust that pays you a defined percentage every single year of whatever's in the trust. If it grows, then that percentage, the gross amount of that percentage, will grow as well. If it decreases, then the gross amount from the percentage will decrease too. The choice that you make in creating these structures kind of depends on your income needs now and in the future. So that obviously puts some constraints on what the income stream can look like while you're here. For an older beneficiary, payout amounts can be higher, and for a younger beneficiary, they may end up being lower. Now, often a charitable remainder trust is structured to pay over the life of the grantor. So this is something that can supplement your retirement income strategy. But this type of tool, as opposed to a brokerage account, is not liquid. It pays a certain amount just like an annuity would. So that means that we can't accelerate those payments. They'll be made in the course and term of the trust itself. The best fit for these types of tools is for higher net worth families who already have their cash flow needs sorted, but they want to take advantage of both charitable and tax advantage planning now. If we just described your family, the next best step is to click the link below in the description. Now, the probably ideal scenario for a North Carolina family using a charitable remainder trust would be families who have highly appreciated stock positions, ones that if they were to sell the securities, they'd realize a substantial gain and have to pay a lot in taxes. Likewise, could have an impact on their IRMA premiums in retirement. This could be things like inherited appreciated stock, a business that you've owned for a long period of time, inherited real estate that has a low basis relative to its fair market value. The family probably wants income, or at least an income stream for a defined period of time or the life of the grantor, but also needs to capitalize on a charitable deduction strategy now. They also are charitably inclined, right? At the end of the day, the point, or one of the primary points or incentives in creating the structure, is a charitable remainder benefit, right? That's the R, CRT, charitable remainder trust. So this isn't something that is an ongoing generational benefit to our kids. It's something that ultimately will pay a benefit to charities that we name and intend to benefit. Now, there's also scenarios where CRTs don't work. They don't make any sense. It's going to be families who have small estates where income is king, and we're not really trying to be charitable, at least not excessively so. Families who have high liquidity needs. They can't sacrifice access to principal like they would have to by contributing to the charitable remainder trust. Or, of course, younger families, younger donors whose lifetime could push far too long for the charitable remainder, that 10% requirement the IRS requires. CRTs are a tool that can work really well when the situation fits, but they are irrevocable and they can't be accelerated. If you have appreciated assets that you want to sell and a charitable intent that you want to satisfy, this is a coordination conversation with your estate planner, your tax specialist, and your financial advisor. And clicking the link below is the next best start. Protecting your family requires more than just standard documents. Schedule your consultation with our team today.